Once interest rates actually started to rise aggressively, what you suddenly found was that a lot of those strategies literally turned overnight from growth strategies to cash preservation. Now, if you're going to preserve cash, first of all, what you do is you don't go for an aggressively pro-growth strategy. You sort of hunker down. And obviously one of the areas that then gets hit, and so that you're right, in the media for capital world, you wouldn't necessarily expect this, simply because you're not, as it were, paying out cash. It is advertising in general. So one of the things that is quite interesting about the markets that did decline, that you saw, for example, very heavy TV declines in 2023 relative to some other markets. Generally, UK, Sweden, Germany got, if you were to look at the biggest markets, got hit the most. Markets such as Italy, Spain, and to a lesser degree France were actually relatively okay. But those are the sorts of markets that tended to have a lot of startup advertising spending. And if you take the UK in 2021, you had, for linear TV, there was 42% growth in spending come from online-born firms. So these are firms that essentially started their journey initially online, and it can go from at the top to the Metas and the Amazons, all the way down to the smaller companies.
At the start of the year, we drew a line and analysed what happened in the media capital sector in 2023 and what founders and investors should expect in 2024. This discussion is part of an exciting series of market reviews that will carry out throughout the year. In this session, we set to cover a few points: how growth stage founders can take advantage of capital solutions such as media capital to fund marketing cost, the evolution of media capital deals and the decline that we've seen in the deal volume in 2023, what are the key sectors and media types that are used in these transactions, also offering a historical perspective, and the differences in media capital activity across markets, as well as leading investors in the space. The foundational data for all these insights is sourced from the MFG Deal Hub, a media capital investment platform providing deal information on over 500 unique brands that have raised media capital spanning the last 20 years. Hi, everyone. Thank you for joining the webinar. I'm sure more people will start tuning in the next couple of minutes. So I'll start by giving some context into today's topic and what you should expect for the next 45 minutes. My name is Diana Florescu. I'm the founder of Media for Growth. We are an investment platform and advisory specialized in media capital fundraising. You'll be hearing a lot about that in today's conversation. Essentially, our mission is to optimize the deployment and fundraising of media capital for startups and media companies. We are delivering on this through a couple of initiatives, including market analysis, like the one that is supporting today's conversation, and discussions like we're having now. But we also partner with early stage founders to finance marketing and branding costs through our annual fundraising programs. And we also work with later stage brands to expand internationally through a more one-to-one bespoke approach. If it's the first time that you are hearing about media capital, perhaps you came across terminologies like media for equity, media for growth. We are going to use them interchangeably in today's conversation. Essentially, it's a venture model where startups that are experiencing growing marketing spending are provided with advertising space and expertise by established players, publishers, broadcasters, in exchange for equity. So there's an exchange of equity instead of cash, which allows the brand to amplify reach, extend capital runway, and acquire new customers. We'll explain the concept in more detail as we go through. And in fact, at the start of the year, we drew a line and analyzed what happened in the media capital sector in 2023, and most importantly, what founders and investors should expect in 2024. This is all based on the Global Review report, which we released a couple of weeks back. And we will be releasing more reports as such throughout the year, looking at specific regions. What we want to cover in today's topic, it's more specifically for growth stage founders, how they can take advantage of capital solutions to fund their marketing costs, but also to go through some of the really interesting insights that we pulled out of that report. And with the help of Niko and Ian, to try to decipher some of the numbers and why we're seeing, for example, a decline or an increase in such investments, We're going to go through some of the key sectors and media types that are used as part of these transactions, also providing a historical perspective, and also the differences in media capital activity throughout different markets, as well as leading investors in the space. If you join a bit late, this session is particularly useful, in my opinion, if you are a founder that is looking to ramp up their marketing, especially investing in brand building, an investor that is interested in a new venture model and exploring co-investment opportunities, but also if you're part of a media company or a publisher that is constantly looking to diversify revenue, attract new advertisers, and optimize ad inventory. All right. So the last thing I do want to say before I introduce my guest, and both are bringing a very interesting perspective to the conversation, is that the data presented in this report and the one that we'll be discussing today is based on the investment information that we have inside the MFG Deal Hub. This is an investment platform designed for the media capital industry. It's free to use. I encourage everyone to go and check out the investment and the information. As of January 22nd, so about a month ago when we released the report, there were 522 startups and close to 600 investments in the platform. And the idea behind this initiative is to support specifically brands to make more informed decisions in terms of where they want to allocate their spending, but also to understand how these capital investments have performed over the last few years by providing a unique perspective on what properties have been used, case studies on some of the brands that have used such investments to grow. Hey, without any further ado, I'm actually going back to the original slide just to see all three of us right there. I would like to introduce Niko Waesche, who's co-founder and managing partner at German Media Pool. This is not the first time we're doing a session together, Niko, and it's always a pleasure to have you. For everyone that, again, is new to the space and somehow to German Media Pool, Niko previously co-founded German Media Pool, is one of the most active investors in the space, an independent media for equity fund based in Germany. And Niko has a lot of experience as an executive in the media industry. He's an early pioneer in venture capital landscape. He had a global and European leadership role with GfK as well as with IBM. And formerly, he was ITV first media for equity fund manager and also strategy advisor to RTL. Niko has a PhD from London School of Economics. And Ian Whittaker, CEO of Liberty Sky Advisors. Ian brings over 2 decades of experience as equity research analyst in the city, specializing in media, tech, and telco sectors. He is distinguished as the only individual to have won the CTAM Analyst of the Year award twice. And his expertise on financial, structural, competitive challenges within this sector is recognized through numerous appearances on Bloomberg, Sky News, CNBC. And I believe, Ian, you've done most recently a talk as part of the Media Leaders event, the Year Ahead event.
Yeah.
Great. I've done my homeworks. Actually, that was a very interesting talk, and I'm sure we'll bring some of the things that you touched on in today's conversation. So I invited both of you because you bring 2 interesting perspectives into this conversation, which essentially boils down to media capital. And I believe that the increasing trend that we're seeing with these investments, because there's been a much higher activity in the last 10 years, to me, it can be attributed to 2 main factors, in my opinion. One, it's the ever-evolving media landscape. And Ian, I think you have a really interesting perspective on that. And 2, the changes that we've seen in startup funding and also the advertising industries and strategies. And Niko, obviously, you've been supporting over 40 companies raised media capital investment. So obviously, I want to get your opinion on that. I'm going to move to the first slide, which basically looks at the evolution of these investments over the last 6 years since 2018. I think one striking insight, in my opinion, is that very often we look at media capital investments as recession-proof type of venture, or one where we would expect the investments to rise when there is an economic downturn, perhaps. But this is not necessarily the case with 2023, when we're seeing these investments declining. In fact, there's a 12% drop in 2023 compared to the previous year. Niko, I would like to start with you, because in the next slide, not in this one, we have actually all the different markets stacked up against each other. And I think Germany has seen a further decline last year, probably to its lowest point in terms of this investment activity. Why do you think that happened, and how much of a correlation do you think that exists between media capital and what's happening in venture?
Thank you, Diana. And also, first of all, let me thank you, Diana, for all that you're doing for Media for Equity. The media industry has not been known for a lot of transparency often, and especially startups that try to navigate the media industry find it very difficult to understand how it works. And so what you're doing really helps startups navigate this industry and make the most use of it. So thanks for that. Yeah, to go back to your question, we've seen a decline in venture capital funding for startups as well as media for equity funding. And as you correctly point out, those two should normally be diverging. In other words, when venture capital goes down, startups could utilize media for equity more to take advantage of essentially marketing spend, marketing acceleration without having to tap into cash funding. It reminds me a little bit of the fact that in the last couple of months, we saw both stocks and bonds decline at the same time, which is something that was extremely unusual. I think the reason that both of these types of investments declined was that there was a huge amount of uncertainty amongst startups and investors regarding what should their future growth trajectory be. We've seen a recalibration amongst many startups. Okay, what should our cost base be? They were reducing the cost base. They're rethinking their marketing plans. They're rethinking their expansion plans. And during this kind of recalibration period, that just very little happened also in terms of media for equity. But I'm expecting this to reverse and to be an uptake this year.
Yeah.
Question regarding Germany.
Yep, please.
I didn't forget it. Germany declined more than other countries. And in fact, as you said, the last 2 years have been slower than previous. I attribute that. I mean, I am in Germany. German media pool is primarily in Germany. And we see this. We saw a lot of uncertainty, a lot of recalibration, a lot of thinking about, what should our growth strategy be, especially with the later stage companies, the ones that are more likely to do media for equity. And that has really, we had a larger pipeline than we've had in previous years. So we've had over 100 conversations last year with very, very interested companies, but there were no deals. What I don't really understand is why didn't this happen in other markets as well? Why wasn't there this kind of uncertainty in the UK and in Sweden where there were so many deals? It's very hard to understand for me, to be honest.
Yeah, we do actually have an interesting, and unfortunately it's not reflected on this slide. This will be part of the upcoming UK report. But in 2022, and actually in 2023 as well, and it's not that huge of a decline, for example, compared to a global view. And you could argue, yes, the UK is doing so much better. But if you actually look at the investments themselves, there's a lot of follow-on investments, which we count as a unique investment, right? So it counts towards total. But actually what that shows is that it's a lot of the companies that have historically raised media capital are deploying or are doing follow-on investments as opposed to attracting new brands to this market. But the next slide actually, and basically backing what you just said, Niko, is that we've also seen, and just looking at some of the reports published by other entities just on the venture landscape, that in fact, media capital investments do follow a similar trend to VC investments. And it actually suggests that it's not just an alternative form of funding, but it's actually part of a broader funding ecosystem. And that was my assumption as well. Of course, there is a huge benefit to raising media capital in terms of preserving cash. However, sustaining such a campaign and also thinking about adjacent costs, it's obviously, it still requires spending and enough of a runway. But going also back to Ian, these investments are also directly impacted by other major changes and macro events that are happening in the media sector, Ian. And everyone knows, I suppose, that overall advertising budgets were down last year. And I think that's something that we can read up on any report. But I actually believe that the decline in these investments can also be attributed not necessarily to just a decline in budgets, but a reallocation of advertising spending to more digital channels, which is something that we'll cover later on. But media capture investments, particularly TV heavy, or TV is the dominant channel. I know this is a very broad question, but what do you think are some of the key major events that define the media sector in 2023 that could have actually led to this decline?
I think really you've got combination of several factors. So I think if you look at, I always great believe that you need to actually look at what's going on at the higher level of things, because it often trickles down then to what's happening in the sector. If I look at this sector, and I think what has been the biggest influencer in terms of why you've seen a decline, it was the rapid rise of interest rates in 2022 that caused that. What you had before was that you had many of these startup firms had their primary strategy was growth, and go for growth at all costs. And it's not just startup firms. You can see it in firms such as the delivery companies. You can see it in a number of the generally tech giants as well. And the stock markets and investors they would reward growth. It's as simple as that, whether they've been in listed markets or whether they were in the private markets as well. Once interest rates actually started to rise aggressively, what you suddenly found was that a lot of those strategies literally turned overnight from growth strategies to cash preservation. Now, if you're going to preserve cash, first of all, what you do is you don't go for an aggressively pro-growth strategy. You sort of hunker down. And obviously one of the areas that then gets hit, and so that you're right, in the media for capital world, you wouldn't necessarily expect this, simply because you're not, as it were, paying out cash. It is advertising in general. So one of the things that is quite interesting about the markets that did decline, that you saw, for example, very heavy TV declines in 2023 relative to some other markets. Generally, UK, Sweden, Germany if you were to look at the biggest markets, got hit the most. Markets such as Italy, Spain, and to a lesser degree, France were actually relatively okay. But those are the sorts of markets that tended to have a lot of startup advertising spend in them. And if you take the UK in 2021, you had, for linear TV, there was 42% growth in spending come from online-born firms. So these are firms that essentially started their journey digitally online, and it can go from at the top to the Metas and the Amazons, all the way down to the smaller companies. The revenue growth is 42%, or the spend on linear TV in 2021 was 42%. In 2021, those online-born companies made up around 21% of all UK linear TV ad spend. I'm using the UK simply because it's the country with the most data.
No, I was about to ask you. So yeah, it's a good point. It's a good reference point.
And that would have continued into the first half of 2022 as well.
Yeah.
And I think what you've seen, particularly in the TV market, and I think, but this is also as well, I suspect, what you've seen more generally across the whole space, is that as interest rates went up, a lot of this advertising was pulled from the space. And in my mind, that's the reason why, for example, TV has had, in particular markets, has had such a poor 2023, but not in others. Yeah. I think fundamentally it's fine, but those are markets that really, TV markets that benefited hugely from the spend that came in from startups. Yeah. So that I would say is the predominant reason.
Yeah, and I was about to reference the study which you just mentioned, and I think it's interesting because we've seen a decline in viewing hours on TV for quite many years, but I think it wasn't until 2023 that the actual TV ad revenues dropped significantly. And I think it's something that personally probably very often gets overlooked, that this online-born companies, and I think it was the ThinkBox study that ran this, and I was speaking to the team, and although the numbers haven't been officially released just yet, we're expecting that decline in advertising spending by digital companies even more significant in 2023. So that would be a study that will come up very soon. And another aspect, which I actually think it's in fact overlooked, and unfortunately I don't have that graph, but it's inside the main report, is that a lot of the brands that have indeed spent in 2021, the likes of Kazoo and What 3 Words and Swift or Eve, I don't know how obvious it is, but these companies have actually spent through a media for equity deal, which again added up to the whole revenue spent, the whole revenue for the media companies, right? Do you expect this to pick up again in 2024? Yeah.
Well, I think it really depends on several factors. Again, let's go up to what is really going to be the key factor here, and that's what happens with US interest rates over the next 6 to 9 months. US interest rates will effectively influence what happens in the rest of the world with this. Now, my own view is that they will probably come down more than what people are expecting. And the main reason for that is just because you have the presidential elections in November. It's a very close race. At the moment, you'd say actually the Biden administration is in a lot of trouble. And I think one of the ways that the administration will try to improve the economy is to pressurize the Federal Reserve to reduce rates. Now, if that happens, then I think what you will see is that you will see a degree of this spending coming back. What I mean by that is it'll lead to a more optimistic environment amongst startup firms, VC and PE backers in general. They will tend to say, okay, it looks as though the environment is more favorable to going for growth again. However, bear in mind that a lot of these companies are not coming back. I mean, you mentioned somebody like Kazoo, for example. I think their share price is down 98%.
Yep.
Yeah, that is not a company that essentially is going to go to the same level of spending that it was before. Same with the food delivery companies. There's been consolidation in the space. And again, the idea that there's been a rapid, that you can grow the market so aggressively, so that those ideas have come away. And I think this is the important consideration to point out. One of the things that you could argue from the big amount of spend that took place just generally in tech funding, second half of 2020, 2021, first half of 2022, is that quite frankly, it was predicated on structural changes in consumer behavior, which have not happened. And so again, that suggests that spend is not coming back. And two, quite frankly, there were a lot of businesses where their business model was quite shaky. And again, when the tide has gone out, those businesses have been found out. And again, what's happened is their value has collapsed close to zero. Those companies, again, are not going to advertise. So if you want a one-liner, it is, yes, some of that spend will come back, but definitely not all of it.
Yeah. And Niko, we've just discussed how much of a correlation actually exists between what's happening in venture with, the appetite, I guess, for startups to go into a venture model like this. Kind of the same question, I guess, that I addressed to Ian, but do you expect the media capture activity to pick up again this year? And do you think that the bar for VC funding is becoming even higher right now for consumer startups?
So I think it is going to pick up. We already have, even though it's only February, we already have some much more, let's say, realistic discussions with startups about media for equity and about the potential of Series deals. So sorry about the dog in the background. So I think it will pick up. One thing that we didn't mention so far yet in the panel is exits. And obviously it's on the investment side, we have to look at what happens to investments, but investors are also driven by exits. And the stock market picking up in the last couple of months has been a very, very positive sign. So there will also be exits this year, possibly even next year, some IPOs. And also around the time of IPOs is also a time when startups do spend heavily on media. So I'm very looking positively, very, very optimistically into this year. And I think a lot of the companies, especially some of the later stage companies, did recalibrate their cost bases last year. They're set up in a very good way. They have partially done some changes in their management teams. They have very strong management teams now. So I'm very optimistic.
Yeah, I can probably just voice the same thoughts. On one side, I think there's been a lot of success from other founders, and I think Ian alluded to interest rates. I actually think a lot of the stock prices did really well last year, and we should expect more tech startups to join the space. Plus, it also, I think, which we'll discuss actually in the upcoming slide about the media properties, but the realization that TV, even if we talk about linear, digital, which actually the fact that TV is not just linear, it offers not only affordability, but also competitiveness to a lot of these brands. There's so much changing in the market that you just can't simply rely on digital channels. And I'm going to also ask for Ian's perspective on that in a second. But what's interesting as well, and again, this is actually something that we will dive a bit deeper into the UK report, is looking at when the startups actually are raising media capital for the first time. And the first time, the stage they're at, it's usually a seed stage or a late seed stage. And if we just look at what's been happening in VC over the last couple of years, a lot of the investors have pivoted to focus more on early stage companies, which arguably protected from market volatility than late stage companies closer to that point of exiting. So I think a lot more investors will be looking to invest at an earlier stage. It's also one of the stages that has been less impacted by the recent changes in the market. And hopefully we'll see more players joining in. I'm moving into the properties or the media properties actually used in these transactions, because there are some interesting nuances that actually vary a lot also by market to market. This is just a global overview that we're looking at right now. And basically the one-liner is that a lot of these investments actually involve more channels. In fact, in majority of them involve even up to 4 channels. And we discussed linear TV, that viewership is declining, yet TV is actually remaining one of the most popular medium. And it's worth highlighting that when we talk about TV, it involves a lot more types of video marketing, including SVOD, BVOD, addressable TV, connected TV. And Ian, I know you have some really interesting write-ups on this. The fact that there's just so many options out there. I think I was actually looking at a study conducted in the US among advertisers, where they asked about 300 such brands where they're going to put their money in which channel are moving forward. And connected TV actually was the first one, even before social media. Of course, arguably US is a very different market from Europe. But is this creating new opportunities for digital businesses, or is the ad market just becoming even more opaque and the messaging is becoming harder for these companies to discern?
No, I think it gives companies more options. I mean, obviously, there's a scale in which people tend to start off, these businesses tend to start off digital, and then when they gain scale, they tend to go onto TV. And I think one argument you might make is, well, if linear TV is declining, is it therefore that the effectiveness of TV is declining over time? And there's some truth in that. But it still delivers a mass market audience that many of these companies want and they need. I think increasingly, I mean, you saw also as well, a deal that was signed today between ProSieben and RTL Deutschland in Germany to do a unified ad tech platform, where what they're offering is advertisers really uniform measurement across linear TV, addressable TV, and connected TV. So we are now starting to see the broadcasters as well making quite substantial moves, and that again will help advertisers, including tech firms, really to be able to advertise effectively across platforms. So the short answer is no. I don't think it's going to be a problem. And as I say, I think it's probably more opportunities because it gives more flexibility to those platforms to really target spend where they want. Because sometimes what you can find is that, there's an element of people go for digital and then they go straight to TV, and maybe in some cases it's a bit too much of a leap. If you have some platforms that are more in the grey zone in terms of reach, that might be a bit more effective and useful for these firms.
Yeah. And Niko, I also want your opinion on this, because I think the way German Media Pool is structured, it's quite an interesting model where you're consolidating inventory from different media players. But TV has been historically the most used channel. Given what we just discussed, what Ian said, do you think this is actually posing a threat to the media capital model as we know it, or is it opening up new opportunities to potentially bring on board new LPs, new media companies, and form a more diverse media stack?
I think that different media types are always an advantage, because different media types have their strengths in different areas. And television has always been really, really good for startups wishing to scale their growth, because there's three things that could be done with TV. And the first thing is generate traffic. The second one is build a brand. I often say, instead of using the word brand, I often use the word building trust, which is interesting for fintechs, health companies, etc. And the third one is the ability to do storytelling, which for startups that have not introduced themselves to their audiences or future clients yet have this unique way of talking about themselves and about their products. So television can do all three of those, but then other media can back up in tremendous ways. Out of home has an incredible presence that's in the urban space. Radio is very strong, for example, still with people driving to work. In the UK, you have very London-centric economy, but in other countries, you have a lot of fragmentation among cities, a lot of people driving in their cars to work and back. Radio is fantastic for that. Print allows you to have oftentimes also advertorials where you can explain. So diversity and different media types has always been very advantageous for startups, and I expect this to increase. So with influencers, for example, which is one thing that you mentioned in the report, yet again, another type of media channel that can be used by startups. Also, the announcements of both Amazon and Netflix to introduce advertising in their streaming is another opportunities for startups. So I think it's getting much more potential than before.
Yeah. And I guess it's something that it's also very visible in your portfolio of investments and how you use these channels, because I believe most of German Media Pool deals involve 3 to 4 channels media types, I should say, not to confuse anyone, media types. But the UK media capital activity actually looks a lot more concentrated with TV. And I'm mentioning this because we're all basically in the UK, and it's also one very mature market. However, actually, if we zoom back and I'm going to skip a few slides. Oh, no, it's not actually unfortunately in here, but one in the report, there is one interesting slide which looks at all the different investors. And 50% of the funds that are currently active are what we call an independent fund. And the majority of them have actually been set up in the last 4 or 5 years. So there is an increasing trend to creating an alternative stack or a media stack. What do you think, what prompts the shift towards a multi-format approach in advertising strategies, which includes all these different channels, media types, as opposed to just doing one?
Well, I think, Diana, I think it's always been there. I think in the UK also, it depends on which kind of media groups are actually offering media for equity. So if in the UK there could be more offerings in terms of radio out of home, I think more startups would be doing media for equity in those areas. So I think many startups have used tube advertising, for example. I mean, on the tube, and constantly see startups using that. So I think startups are actually using all the keys on the piano, but maybe just few of those are used using media for growth deals, and the other ones might be conventional cash deals. So I think it's not something that's very new. I think it's rather that independent media for equity funds can actually offer all of the keys of the piano, all of the possibilities. So that makes it even easier for startups.
Yeah. Unfortunately, and I agree, it is something that we haven't necessarily seen done in the UK, where I think it's a very interesting market. And actually, this is probably a subject for a different debate, maybe for the next report. But you have a very mature market with most of the broadcasters offering such investments. But we don't have, for example, a German media pool fund in the UK. So I think it just poses a question, or it's essentially the debate whether there is a need for more strategic alliances as such, not just for the startups, but also based on what Ian said and the changes happening to basically build defensibility against some of the market changes. Let's go on to sectors, because I think, Ian, you also talked about some of the sectors, and Niko, you referenced fintech and about building trust, which I think a lot of these sectors, such as healthcare, or if it's a product that requires a lot of explanation or expertise, I think the financial sector particularly needs a lot of trust, especially after what happened to the FTX scandal. I don't know if have you both watched Super Bowl this year? Are you a fan of watching the ads? I usually tune in for the ads.
Some of them.
Okay. But it's interesting, like I think 2022 was the first year, no crypto ads. 2023, or actually 2023 was the first year, no crypto ads. And this year, the second year in a row, no fintechs. And the thing is, TV can build trust, right? As you said. And what we're trying to show here is what are some of the sectors that historically, this is 2023, but also historically attracted these investments. And if you are a media person, or if you follow who are the heaviest spenders, this shouldn't come as a surprise. Healthcare and financial services, they do also spend millions in cash to advertise on TV. I'm more interested, Ian, do you think the sectors, do you expect this to change much in 2024 in terms of who are like the top maybe 3 to 5 spenders?
I think if you look at it sort of face value, the answer would be probably not. I think, but go back to what you said before, Diana, in terms of you look at, there were no crypto ads, there were no fintech ads in 2023. And I think that's probably the key to the question. It all really depends on what's happening with these sectors at the more macro level than anything else. So really, if you're thinking about who is going to spend and who's going to come in for media for equity, what I would almost say is look at what were the hot sectors at the moment and what are the sectors that are falling out of favor. Something like a fintech, you would say for multiple reasons, probably it's less in favor than it has been previously. You've got some other sectors, though, where, quite frankly, again, you could, it's not necessarily sort of, they wouldn't naturally be sort of more in the space, but certainly for investors, defense and energy are very big sectors at the moment. So I think what you need to look at it is you need to look at what are the sectors that are in vogue and attracting investor capital at the moment.
Yeah. And also, I think, Ian, you alluded to this before, but the shifting consumer trends and behaviors and preferences, I suppose. And again, sorry for referencing Super Bowl. I'm not necessarily a fan. I just love watching their ads. And I think it does actually set the trend. But some really interesting changes this year. Again, I mean, you've got new entries from CPG brands. I think health conscious soda, which is like $2.5 a can, quite premium, which is been trying to do a bit of soda shaming and trying to educate consumers about the benefits. And at the same time, you've got a significant drop in alcohol brands promoting, right? So, Niko, what's your opinion on this? Are there any specific sectors that you believe will come more into prominence in 2024? Is something that, or any specific sectors you particularly are looking at as part of the fund?
So we're interested in all consumer-facing industries. And what we shouldn't forget is that all of these sectors, they're huge industries in themselves. Health, mobility, fintech, these are huge industries, billions and billions of dollars. What we look at actually is not just the industries, because we got a very, very wide perspective on all consumer-facing industries, are the horizontals that can go across these industries. So one such horizontal, for example, is decarbonization, sustainability. So you can have mobility paired with decarbonization. You can have health paired with sustainability. And another one would be, I mean, you just mentioned it, by the way, with the fact that people are trying to live healthier lives, more in tune to the environment, but also to their own bodies, and going away from alcohol consumption or strong alcohol consumption towards healthier food. So all of these things are very interesting for us because they also represent very authentic kind of startup themes that new, fresh brands can actually embrace with a lot of authenticity.
Yeah. I mean, I think the topic of longevity is also coming up a lot more right now in conversations on the venture landscape too. And hopefully we should see that reflected in some newer entries into the space as well. One thing that I think I should probably mention, because we do on this slide disclose the investments, the actual value. Across our investment platform, we made an informed decision not to do so. I think that also relates to the fact that the way we communicate media spending across markets is not always consistent or uniform, and some information also have to be confidential as part of our partnerships. However, what we do want to show here is what some of the sectors that have, in fact, attracted some of the largest spending. And I think the usual suspects, which we just discussed: financial services, food and beverage, healthcare, pet care. Actually, pet care as well. It's another sector that is coming up more and more in conversations, as well as feminine hygiene and travel, I think, this year. And one thing that I would actually add is that, again, doesn't come as a surprise if we look at how much these sectors spend on advertising as part of their revenue. 40% up to even 60%. Someone like a HelloFresh, for example, which is, food and beverage marketplaces, spend up to 60% on advertising. I don't know if you have any other thoughts on any of the sectors, but it's just supporting the statements that we just made.
Yeah, maybe just a really brief comment. Yeah. I mean, I think that some of these digital companies, it's very difficult to differentiate marketing from sales because it's all part of the same, let's say, spend in a way.
Yes.
And so when HelloFresh spends such a huge amount, it's also a lot of almost direct sales activity that they're doing over digital channels.
True. It's bundled in the same cost line. Yeah. Which actually is a perfect also kind of segue into future outlook. And I think one thing that I also believe that Media Capital could potentially do in terms of changing or shifting mindsets. And I know you talked about this, Ian, in one of your previous articles. It's basically taking advertising from being an item on your CapEx to moving into your cap table. So if you're a CFO, if you're a CEO, if you're a chief growth officer, you're no longer necessarily relating to advertising as an expense, but more of an investment in your brand. Do you expect, and I think you already kind of covered this, but this is more like a summary slide. Do you basically expect resurgence in TV advertising among these businesses in 2024? And how much of this shift do you think is going to happen among CFOs?
Well, I think if you look at big advertisers, I think you could already see, we had comments again from the likes of Nestle and Danone today, talking about that they're going to invest further in advertising and promotion because they see it as driving their business. So the phrase I always like to use is that the past 18 to 24 months has been a vast unplanned experiment in showing how brand strength contributes to top and bottom line. Because you listen to companies on their conference calls, they talk about how effectively it's been brand strength that's enabled them to push through price increases to consumers that they thought they would never be able to get through. Now, again, so I think from a platform standpoint, I think what happened in 2023, and again, just to go back to the TV market, was there was a lot of stuff that was almost as it were was going on underneath the surface. I think generally bigger advertisers still continue mainly to use the TV platform because it works. But as I said before, if you've got 21% of the, and we'll wait for the ThinkBox study, but if you've got 21% of your market where advertising spend probably wasn't down 5-10%, but let's say was down 30 to 40 among certain categories, that's a huge drag effect that you get coming through. And so from a comparable standpoint, that should go away this year. So the short answer is, I don't think it's going to be a particularly strong year for TV, but I think there will be some growth. But I think it will be also as well very second half weighted.
Yeah. And Niko, you already mentioned that you expect these investments to pick up in 2024. Is that something that you would expect to see across all markets? And where do you think Germany is going to sit on that ranking again? But also more, I think more personally as well through investment activity at German Media Pool. Are you actively looking at new deals?
Definitely. We're actively speaking to several companies right now and should be able to make some announcements in the next weeks and months. So yeah, I mean, a personal ambition should be that Germany goes back up there in the rankings. We've always been the leader in media for equity, or at least amongst the top three. It's very depressing to be in fourth place. I feel like as a German football team at the moment.
Oh, Niko, don't be that.
So we got to do something there, and we will.
Yeah, and I'm sure you will. And Niko and German Media Pool has been a very supportive partner of the fundraising program, and I think we've got a lot to look forward to into 2024. I do have one final question to both of you, and it's a very broad question, so please feel free to answer however you see fit. But what do you think will be the most significant kind of macroeconomic development or element that you will see in your sector that will impact the media capital venture this year? Perhaps Ian can start with you, or
I go back to the same answer that I gave before. It's what's going to happen with US interest rates. I think that will trickle down all the way through to what happens in the markets, obviously across the US, but throughout the rest of the world.
Got it.
So the most significant development, it's not really macroeconomic, that would be pushing it. It's probably somewhere between micro and macro, but would be the first seriously interesting exits happening this year. So if we have some larger trade sales happening, if we have some, maybe towards the end of the year, some exciting IPOs in Europe, trade sales, in Europe IPOs, if we see those things happening this year, then we'll have a major pickup.
Thank you both so much for joining, first of all, and just sharing the thoughts on this. It's the first time we're doing, I think, a webinar of this nature, but it's part of a series of more conversations that hopefully people, founders, investors find it useful. The next session, which we already, I think, covered a lot of already because of our UK affinity, it will be on the UK market. And during that session, we will touch on this upcoming MFG fundraising program, which takes place in London. And we have online sessions as well happening throughout the month of May. Niko, as I mentioned already, he's been very supportive. He was part of the previous cohorts, and we're looking forward to having you involved again. It is the second year we're running it, and essentially it's a free 4-week specialized program for seed and Series A consumer startups looking to optimize their media capital fundraising and cover their marketing costs. So if you are essentially a founder experiencing growing marketing spending and you're looking for clever options to cut back on spending, but also to be connected with top execs and investors and understand more about what it takes to build a brand, I think this is something that you could potentially consider. We haven't opened applications yet, so they will be live on the 26th of February, and we're looking at them and reviewing them on a rolling basis. So any investors or founders interested, there should be a link in the comments for more information, but you can also just drop us an email if you have any questions. I believe we're running out of time, but I really, really want to thank you both again for taking the time to join and really sharing your perspective on this. We need to do this more often. Really appreciate it.
No problem at all.
Thank you, Diana. Always great talking to you.
Likewise. Thanks, Niko. Thanks, Ian.
Take care. Bye.
Thank you.
Thanks so much for listening. I hope you enjoy the show. You can find the full video episode on YouTube on the Media for Growth channel, or you can listen to it on Spotify, Google, or Apple Podcast. And let us know what you think by leaving a review. The full script and more investment insights are available via our Media for Growth monthly newsletter. See you next time.